Hi, it's Jim Griffin of Derivative Logic here to get you straight to smart. Long-term interest rates rose anew last week with the yield on the US 10-year Treasury note marking a new one-year high amid concerns that the Fed's new policy framework could leave the central bank behind the curve as inflation heats up. For short-term interest rates, one-month LIBOR and SOFR were both little change near record lows. With short-term rates pinned down, the recent rise in 10-year yields has caused the yield curve to steepen to levels not seen in 5.5 years. Looking to last week, as we expected, the Fed maintained its easy money stance in its monetary policy meeting, maintaining the glide path for both interest rates and asset purchases which it established last year, and doesn't appear to be anywhere close to altering its stance anytime soon. In essence, the Fed has established a growth now, jobs later theme of sorts to its policy stance, expecting much faster growth this year, mostly in response to the massive fiscal stimulus now being unleashed on the economy. The Fed believes it will in turn drive unemployment lower eventually, but with only minimal impact on the inflation outlook, giving them the slack they need to let the economy run hot before tapping the brakes many months from now to keep it all in check. As we've said for months now, the Fed is mostly focused on creating the conditions necessary for a jobs rebound, which, while improving, remains elusive. As such, the scope of job creation, not the pace of economic growth, nor the level of long-term interest rates, will guide the Fed's hand in the months ahead. In the meantime, long-term Treasury yields like the 10-year Treasury will be free to climb even higher than they are now as they further assimilate the improving economic prospects. For the week ahead, the data slate is filled with mostly second-tier indicators that reflect activity that took place between two waves of fiscal stimulus, and as such may reflect a brief hangover of sorts. Hence, don't be surprised or come to false conclusions if we see data this week that's much worse than expected. Next month's reading on the same data will likely be much better. From all of us at Derivative Logic, have a great week.